Okay. Welcome everyone today to the importance of cash flow. It is a very important business topic, so much so that our friends at East Cambridge Savings Bank have sought us out to sponsor this presentation today. And they will be giving I'll be introducing them here shortly, but I want to first start with our two presenters. We have Jim Danhauser from SCORE Cape Cod and Gloria Spence from SCORE Boston. And as we get started, I want to tell you a little bit about SCORE real quick. There's a couple of key things to know about us. One is that we have a great website with lots of information for you, templates you can download, blogs you can read, different, informational type programs. So I definitely strongly encourage you to look at the SCORE website. The other thing we do is the workshops and webinars. Watch for our newsletters. Those are also listed on the website. They're invaluable and cover every topic you can ever imagine. The most important thing that SCORE does, however, is provide mentoring to small business startups and those that are already in business. We work with those that are trying to decide if small business ownership is right for them, those that are in that planning phase, and those that are already in business. Our mentors have a wide variety of experience and come to us to help all folks in all areas. So I strongly encourage you to click on that, or to use that QR code to connect to the SCORE website and submit your request for a SCORE mentor. Sessions are very low key. They're the first session is going to be getting to learn about you, find out what your goals are, what your challenges are, and that mentor is going to work with you to formulate a plan to achieve those goals and overcome those challenges. Oftentimes they will invite other mentors in to work as a team as your needs change. It's just a great resource. So I really strongly encourage you to do that. If you don't want to use the QR code, you can go to the score.org website. You can type your zip code into the little blue box and it'll match you to the right chapter. It'll ask you for some information, and then that chapter will use that information to match you to the mentor that can help you the most. Today, we will be using the Q&A tab. We usually do get a decent number of questions on this topic because it is so important. So if you could use the Q&A button on your Zoom bar to submit questions for the presenter or for the bank, and the bank will be back at the end to also take questions if you should have them. The recording will be available in approximately 24 to 48 hours. It'll be on the score.org/Boston website. Look under the local workshop tab for previously recorded, and you will find it there. So I'm going to stop my share, and I'm going to go ahead and let Robert Nichols from East Cambridge Savings Bank go ahead and introduce the bank real quick.
Thank you, Teresa, and thank you everyone for joining the webinar this afternoon. It's nice to be back with SCORE again. SCORE has been a great partner to work with, and we continue and are willing to provide these outstanding workshops. East Cambridge Savings Bank is a mutual savings bank. We're not a publicly traded company, and we don't have investors. Mutual savings banks have been around since the early 19th century and are so common in New England. Our bank was founded in 1854 and has been operating with the same name and charter since then. We have never been acquired or sold to a larger bank. Now, since East Cambridge Savings Bank is a mutual bank, does not have shareholders, we reinvest profits locally through mortgages, loans for small businesses, and supporting nonprofit organizations. Thank you, and back to you, Teresa.
Thanks, Robert. And Robert and Seth will both be back at the end of this presentation. Again, if you have any questions for them directly, please put them into the Q&A section on your Zoom bar. So I'm going to now introduce our presenters, Gloria and Jim, and they will be teaching us about cash flow. It's all yours.
Hello, everyone, and thank you for joining us. I hope you find this useful. And as Teresa mentioned, please, if you have any questions, just put them in the Q&A. And between Jim and I, we will either insert them when it's appropriate during the presentation or save them for at the end. So please don't hesitate to ask questions. So what we're going to cover today, we'll do a brief overview of all the financial statements. We'll talk again briefly about startup costs and budgeting. And obviously, we're going to get into the details and nitty-gritty of the cash flow statements and what they can do for you, why you should have one, how to work with them, and a lot of other little tidbits that would be helpful. And then, of course, we're going to talk to you at the end about managing, forecasting and managing your liquidity, which is another good reason for having a cash flow. And do I have? There we go. Okay. So the objective of any financial reporting system is the goal is to gather accurate and complete information in a timely fashion. This allows you to make better, smarter decisions about your business. The key to all of your reports is accuracy, completeness, and of course, the timeliness. So there are three basic financial statements. A budget is not a financial statement, but it is an important part to the process of a new business. So the first one is an income statement, and it's also called a profit and loss statement, and it's also called a P&L. And what this report does is it shows the results of your business for a defined period of time. And it is all generated by what you put into the system. It's all of your transactions, your ins and your outs, and it puts them in an organized fashion for you to make decisions from them. A balance sheet is a reflection of your financial position, and it's about your assets and your liabilities. It's about what your business owns and what it owes, what its debts are. And thirdly, the cash flow statement. And the cash flow statement shows where the business's cash has come from and where it has gone over a period of time. And it also helps you to project the future and to project as best you can what's going to happen in the coming months so that you can plan and prepare for it. Usually, small businesses are running a tight ship. And so they need to be aware of, are they going to have enough money to meet your payroll? And going forward in the future, are you going to have money in there to pay your bills, etc.? The budget is really something that all new businesses and current businesses should prepare. You should do that at close to the end of your fiscal year. And it's also the basis for your cash flow statement too. Startups. Now, we're not going to spend a lot of time on startups because it's a whole nother topic that SCORE covers in another presentation. But we strongly encourage all startups to prepare a cash flow showing the costs, your costs of your development and planning and getting ready to operate. And it should include your costs expected for the initial period of 6 to 18 months to ensure that your cash available is enough to at least reach break even. And it should include a contingency because you always have unexpected expenses that come along and you want to be prepared for them. And again, as I said, the webinars other webinars will focus on the startups exclusively. So your monthly cash flow statement shows the movement of your cash in and out of your business, and you develop an ongoing discipline of looking at your cash flow at least monthly. If you, again, are a new business and you don't have a lot of cash cushion, you should be looking at your financial statements more often than monthly. We've got some templates here that you can take a look at and see if they help you or not. So, cash flow statement, how do you prepare a cash flow statement? How do you go about it? And two of the things that you have to start thinking about before you sit down to your desk and say, okay, how much cash am I going to need to run my business? And that entails listing all of your expenses. And when you're first starting out, you want to list as many of them as you can think of. And you can use your bank statement to guide you on doing that if you don't record them as you're going along. The second piece of this is, how much cash do you want to take away from the business? Now, if you're sole proprietor, you're going to just be taking the cash out of the business. If you are an LLC or something else, you could be taking out a salary. If your salary is included in the business expenses, then you don't have to really think about taking out, well, yeah, you do. You have to think about how much you're going to pay yourself, because you want to set that up in the beginning. Do I want to get $5,000 a month, $60,000 a year, whatever that number is, because at the end of the day, you want to make sure you have enough to pay yourself. So you take a look at what you think is going to happen, and then you kind of look at what reality is. And what I mean by what is reality is you may say you want to take $150,000 from the business. But remember, you've got to find and make sure that you've got enough flow of revenue coming in to cover for your $150,000 salary. And when you go through the gyrations of your expenses and then how you're going to bring this money in, you may find out that your wish, at least in the first few years, of X amount of salary is not viable. So you have to plan for that. So the other thing we're going to just how to use it to manage your business. But the next thing we're going to do is we're going to go into, and I'm going to show you what a cash flow report looks like. It's a very simple, very basic Excel spreadsheet. And what this does here is I have a couple different tabs on this, and because here's the basic budget overview, and again, this is a very brief version of it all so that we can see what happens to the report when you make changes to it. Here's as many lines as you could possibly have for your cash flow report. You can have this many or you cannot have that many. And these gray areas here are actuals. So what this means is you start out with 12 months worth of forecast of what you think is going to happen. And as each month closes, you go in and you insert your actual figures and you put them in. And now they become actuals. And this amount down the bottom here is always should balance to your bank statement. Now, so then what happens is then that balance carries up here to this number, and you repeat it again. So these, because they're all in the gray area, are actuals. These in the blue here are still forecasts. We've not hit April yet. So let's go back. I want to show you what happened here. And you'll see here in the beginning, I was forecasting that my income was going to be 14, 15, 21, 24, 29, and 36. Remember 24, 29, and 36. Because now look what happened. I had to come in here and reduce these numbers. Because, and I'm using the example of COVID, but it could be any major adjustment to your plan. This business realized that because of COVID, they weren't going to realize their plan. And so they had to come in and make adjustments. And so they reduced the revenue, which is going to come down here and reduce your cash each month at the end. So you want to do that. And then of course, you also want to go in there and start to reduce your expenses as well. Let me go back here. You want to go back in here. Okay, I just can't reduce my revenue. I've got to reevaluate my expenses. And some of that may include laying off people, which which you may have needed to do. So the other thing too that you want to remember is what can I do here to save money. How do I, how do I do that? And you may end up finding out, that what your revised plan is still going to bring you a negative number. And that's really what you want to know is when and at what point am I going to get to a negative cash flow? And this is what the importance of this report is. Now, so not only do you need this report to manage your business and for it to tell you when you are going to lose money or may lose money, it's also important for you to plan for the future of your business. If you start finding out that you're getting more and more revenue in and more income is going to the bottom line, this is a sign for you, maybe I should look about what I'm doing. Maybe I need to expand. Maybe I need to hire more people. It's a good report for not only in the bad times, but for the good times. Another reason for it is when you are planning and you find out that you might need to borrow money, you are going to need a report like this, because I'm sure the Cambridge Bank is going to say what they want to look at when you are applying for a loan. So that's another reason why this report is very important to small businesses. So any questions that we want to ask now before we go any further?
Somebody had asked if we're going to send out the template, and I indicated we would be happy to do that.
So let me just show you real quickly what will happen. So look here in I forget which month, October. Yeah, in October, we had planned to pay the insurance all in one lump sum to avoid some additional payments, $4,100. If I'm if I'm in the red, this is one place where I am going to go in there and change my expenses. Reach out to the insurance company, say I want to put this on a monthly payment plan, and then all of a sudden now you go from $500 a month, and that kind of helps you a little bit. It's still not helping you a lot. It's not helping you enough, but whoops. But it's telling you, it's showing you now a little bit of help. And again, if you want to go up here, another big place for your expense, is your payroll. How do you cut back before hurting your actual product or your business? How much do I cut back on payroll? But the point of this is that you can go in there and play what if games. What happens if I reduce my payroll? If you reduce your payroll, which may be your salary, if you're getting paid through payroll, now it puts you in the black for 2 more months. And obviously the next month that problem will resurface again. But if you do reduce your payroll to $5,000, that month it doesn't get you out of the red. So you got to do something else. So the point of this is that this worksheet, you can go in there and play what if games for the different lines and help you get to where you need to be to start making the right decisions.
Gloria, somebody asks, how long can a company stay in the red?
Not long. You can't.
That's the right answer.
If you get into the red, you are going to have to dip into your own personal finances to fund this. You got to find the money. What happens is you stop paying your bills. Or what happens to your employees? Are you going to stop paying your employees? You can't. That's why that's very important to know that in November, I'm going to run out of money and I have 3 months to do something about it. Yeah, you can't. Because, like in your own personal, think about it, in your own personal checking account, what happens when you run out of money there? It's a good question, though.
Someone asks, is this something I can expect a CPA to help with?
A CPA, you could be paying them a lot of money to help you with this. You definitely don't, I wouldn't recommend a CPA to help you with this. They cost a lot of money. Anybody else disagree with me?
No, I think you're exactly right. You may want to use a bookkeeper in some way, shape, or
Yeah.
form if you simply are not comfortable putting numbers together. But as the owner and operator of a business, it's your responsibility to understand what cash you have and what cash you're going to have on a going forward basis.
And a CPA or a bookkeeper, nobody is going to know your business like you do. They're
Right.
not going to be able to tell you which numbers to change. Only you are going to know which numbers to change.
Think of it this way. They're much better at looking at the past. You're the one who understands what the past means for the future
Mhm.
of your business.
Exactly. Good way.
And
Good
if these forms are too complicated, do something that you are comfortable with. Even if it's pencil and paper or looking at your bank account, but in some way, shape, or form, find a system that works for you that you can stay on top of your liquidity.
And again, to pitch SCORE, if you're really having trouble analyzing and wanting to know if what you've done is any good, reach out to a SCORE counselor and they can review it for you. Any other questions? This is the most important report for a small business.
Right.
And it's probably the hardest one too, because you have to really know and understand your business in order to have this report be productive for you and accurate. Be happy to answer more questions later on if they pop into your brain based on what some of the other material we cover.
Okay, Gloria, then you stop sharing.
There you go.
And then I will share my screen. Okay. Gloria has given us a great backdrop in what a cash flow statement is. I'm going to talk more generally and try to give you some hints that you can use in managing the liquidity in your business. Everybody will tell you that cash is king. There's a reason they all tell you that. It's because it's true. If you look at small business failures, almost all of them spring from the business running out of cash. It is simply a death knell for a small business unless it has been planned for. I used to tell people who worked for me that we could survive anything so long as we didn't run out of money. You can always live to fight another day. So it's your job to stay on top of your cash resources and not just your current cash balance, but your ongoing balance and your future cash needs so you avoid a liquidity crunch. There are some simple things that you should be doing to give yourself some help in accomplishing this task. First is you absolutely should be keeping a separate bank account for your business. I can't tell you the number of times I've dealt with people who intermingled their personal expenses and their business expenses, their personal income from other sources and their business income, and got so confused as to which was which. Keep a separate bank account for your business. Run only your business income and expenses through that account. And that's the easiest way you can then look at your bank statement and your bank balance online to see what the cash is. It's the easiest way to monitor the cash. If you use an accountant, they'll also be very happy you do that because it makes tax return preparation enormously easier. If you can, we would suggest that you keep a separate credit card for your business as well. I know that there's a cost associated with a credit card, and some people say, won't a debit card suffice? And the answer is, if you have to, okay, but it's much better to have a credit card because you are beginning to establish credit for your business, number one. And number two, there may come times in the course of your business operation where the only resource you have to deal with a required expenditure is to put it on your credit card. Whether you're buying inventory for a season and you will work it off over the next 2 months or some other factor. Be aware that credit card debt, if you don't pay it off in 30 days, is the most expensive form of debt around. So we don't advocate that you do that unless it's absolutely necessary. and work to pay that balance back as soon as you can. You should, as Gloria said, look at your cash flow statement at least monthly. And I would tell you that at least in the early stages of your business, you should be looking at it more frequently than that. You absolutely need to keep that budget and cash flow forecast for the next 12 months. And as Gloria was showing you, keep it updated because things change. And you need to take account of those changes to make sure you're on top of your liquidity needs. Importantly as well, many businesses are seasonal. I know here on the Cape, everybody feels great in June, July, and August. But in my experience, every year so far has also had a January and a February. And if you're not taking account of the ebbs and flows of the seasonality of your business, you could find yourself very surprised to have a liquidity problem. So keep a full 12-month forecast for the next 12 months as often as you can possibly do that. You should keep good accounts receivable collection practices, and I'll talk about that for some time because that's something I see a lot of small businesses run into trouble with. And avoid overdoing it on supplies, inventories, and equipment. I know everybody always wants to have the full range of everything they could possibly need, but only get what you need to have, not what you'd like to have necessarily, because those things eat up cash. And I'll talk some more about that as well. So again, prepare a cash flow forecast each year as part of your budgeting process and update it every month or more frequently if you have to, and look carefully at the next week and month to see if there are immediate issues that you need to attend to. Because again, things change, but most importantly, you can't make smart decisions about your small business. Should I add staff? Should I take on additional work, which often means additional expenses? Do I have to reduce expenses? Unless you can see what your cash flow situation is going to be over the next 12 months. And again, bear the seasonality of many businesses in mind as you're doing that. What do you do if you see a cash flow shortfall on the horizon? Well, you have to take steps to deal with that as early as you can. You could seek working capital or other loans. Working capital is a fancy accounting term for the excess of your current assets over your current liabilities. What is my cash and accounts receivable and inventory over my accounts payable and short-term loans? You can seek working capital financing from a financial institution. You reduce unnecessary expenses. You may delay purchase decisions. You may accelerate collections. You may delay payables. But all of those things are options for you if you see a cash flow shortfall looming. For near-term issues where you're just going to be up against it and you don't have options, you may need to slow down payables. And that's when you'll have to make a judgment about whom you talk to about why you're doing it and what you will be accomplishing to make up for the shortfall over the intermediate term. You don't want people to have a feeling that you're running out of money, but you need to husband your resources carefully. And if possible, try to keep cash reserves and or establish a working capital line of credit to help you deal with any shortfalls. I'm going to spend just a few minutes. I know this is just a 6-month forecast and not a 12-month forecast, which I just finished telling you have to do. But here's another reason why you have a forecast. Okay, this is a company that started the year with $20,000 in the bank. They got through June, they still had $6,000 in the bank. That's not so bad. That's because they had $14,000 more of an outflow than an inflow. But, and this is just a small example, but it makes the point. Look at what happens in March. Suddenly they're in a negative position. How did that happen? Well, you'll see they made an equipment purchase in March of $12,000. Small numbers, but the example holds. If you're running this business, would you have made that equipment purchase in March for $12,000 if you knew it was going to drive you negative? Or would you have delayed that purchase? Or would you have maybe sought to get financing in connection with the equipment purchase? Because that's often the easiest form of financing available to a small business. You'll see that they made a significant number of inventory purchases in the early in the year. Maybe they should have slowed that down. But again, unless you have a forecast that is telling you what is going on with your business, you can find yourself making a decision that puts you up against it when you really didn't have to be. And that's what you should try to avoid. Accounts receivable. I see there are some questions. Should we deal with those before we get there?
We can hold it. It's
Okay.
yeah.
Accounts receivable. Now, you may be in the luxurious position of not having accounts receivable in your business. And if that's the case, good for you. But it is a very major issue for a lot of small businesses. So I'm going to spend some time talking about the practices that you should have in place. Number one, timely billing. You get your bills out as soon as the work is done, state what's been done, what's owed, and when payment is due. Sounds very basic, but it's very important. I can't tell you the number of times I've dealt with clients who get bills out, 45 to 60 days after the work is done. That's not a smart practice to develop to make sure that you don't get into a liquidity problem. You should send the bills out by email and by regular mail. Make clear how checks should be made out and where they should be sent. And if you're taking online credit payments, make sure you make that clear as to how that is to be done. And many businesses are now doing that, and it eases up their issues very significantly. You also get to know who at your customer is actually making the payments and communicate with them regularly. And most accounting systems, QuickBooks, etc., have invoice features. So you can just have the system prepare the invoice, you enter the information. And that's the easiest way to do it because it's the easiest way to keep track of who's been paying and who has not. If you see that people are paying slow, get reminders out. And then if you have problems with a particular client, you can send a formal letter, making sure that you only say that it's an effort to collect. You could consider legal action, including small claims court. And I have a client on the Cape who always takes people to court if they don't pay them. But be careful because there's expense involved, even if it's just your time, and check the ability of your debtor to pay. So be prepared to cut price and collect what you can before proceeding. And by all means, don't continue to do business with customers who aren't paying you. There are other ways that you can reduce your accounts receivable issues. You could think about early payment and prepayment discounts for customers. For example, I have someone who takes care of my irrigation system. And every year in the early spring, they offer a 5 to 10% discount if you pay the full year's amount. Why did they do that? They don't have to worry about accounts receivable. They get some cash in at a period of time where they might otherwise be short on cash. I would not tell you to go much higher than 5 to 10%, but if you find yourself being able to collect significant amounts of money earlier on and not having that problem, then it's something that you might consider. You might get credit card authorization for regular customers and charge that card after the invoice is approved, but be careful because you need to safeguard that information if you get it. Many service providers now use mobile payment apps. They are inexpensive, they are readily available, and they allow you, for example, the fellow who comes and cleans my fireplace, he won't leave the house until I give him my credit card. He swipes it and he's paid in full. Never has a collection problem as a result. If you happen to be in the construction business, if you got a big project, get a payment schedule up front as much as you can, because you're going to be buying supplies and otherwise it's on the client's nickel. Other working capital tips, as I said, avoid overbuying. If you have too much inventory, think about it. If it's still sitting on the shelves, do whatever you can to move it because that's effectively cash and it's not going to get more attractive as it ages. Always make purchasing decisions with the impact on cash flow forecast in mind. And this is something that you really ought to be thinking about. Don't pay your accounts payable early. I know everybody wants to be a good customer, but if somebody gives you 60 days to make a payment, pay it in 60 days. Don't pay it in 30. If somebody gives you 30, don't pay it in 2. Because if you suddenly run into a problem, you'll regret having written that check early. And I'm going to emphasize this again. If you have employees and you have tax withholdings, or you have sales or meals taxes, pay them over to the authorities as and when they're due. That is not your cash. I have seen people over the years run into a little problem in their business, and they dip into a sales tax collection, thinking to themselves they'll make it up before they have to pay it over to the authorities, and inevitably they don't. So do not use that money as yours. You're going to end up with criminal penalties if, in fact, you try to do that and can't make it up. Okay, so now you're in a situation where you want to think about financing. This lists the usual sources of funds. Family and friends is a colloquial expression. It means anybody in your network. You may have personal savings or assets, including retirement funds. But every time you think about using those kinds of assets, stop and think about what risks you're prepared to take for the money that you have put aside, because everybody has a different risk quotient in mind. You can use credit cards, which I mentioned. They typically have a high cost, but they can be available to you. Bank loans. Bank loans, the old joke is that large commercial banks are very happy to loan money to you so long as you can prove that you don't need it. You're much better served to deal with local banks, community banks. They are much more receptive to dealing with small businesses. They're much more accustomed to it. You can also explore SBA financing. Those can be made. There are some programs that come directly from the SBA. Others are bank loans that get SBA support, particularly if you're buying assets like buildings and other equipment. You can find that SBA financing may be a viable source of funding for you. Equipment financing and leasing. For many small businesses, this is the most readily form of financing that might be available to you, because the people who are selling you the equipment are accustomed to dealing with it. And if you are unable to pay, they're much more comfortable taking that equipment back and dealing with it than might be an outside lender. So if you're buying major pieces of equipment, explore getting financing or leasing it instead of just buying it outright to help you with your liquidity. Seller financing if you're buying a business. Remember, however, that seller financing is still debt. And if you can't pay it back, you may lose the business and all that you invest below it. Online lenders are a ready source of financing for many small businesses. There are a number of those sources available, and we can get you a list if you'd like to explore them. They are flexible, oftentimes more flexible than certainly the larger commercial banks and national banks. But be aware that they can be expensive because you will get short-term financing from them. You will pay fees. And if you start calculating your average percentage interest rate, it can be much higher than the interest rate that is stated that you're actually paying. But it's an available source of financing and should be considered. People talk about crowdfunding a lot. It's very difficult unless you have a very special circumstance that you're looking for. You're going to have to put videos together. It requires a significant amount of effort and time. So we would encourage you generally to pursue other sources of financing before turning to that. As I said, bank financing can be difficult for new businesses. You'll be better served to deal with community and local banks. What will banks look at in terms of considering your financing? And I'm sure the bank itself, who's on the call, will have some points to make on this as well. One thing they're going to look at is collateral. How can the bank be comfortable that you're going to be able to repay them? They may want to take a mortgage on your business or your personal assets. But one thing is for sure, in most circumstances, they're going to want you to sign a personal guarantee. That is not necessarily because they want to sue you to collect the money, but they want to understand that you have confidence in the business enough to say that if the business won't pay you back, which I think it will, I will. The bank will also look at your character. What do I mean by that? They'll look at your experience and your education. They'll want to understand your business plan. And they'll want to know why it is that you believe you can be successful. So before talking to a bank about getting financing, you want to have a real plan in place. You want to have the cash flow forecast that Gloria mentioned, including the startup period. And you're going to show that you've done your research. Here's what my competition is. Here's how I know I can manage through that competition. And they will look at your personal credit to be sure.
Jim, can I interrupt you?
Sure.
Well, I had a question. Where did it go? Anyway, someone asked about is if you have a really good cash flow and a good profit, how important is it is the credit piece of it? And my response to that is the credit is very important to getting a loan or any approval. It's one thing to have a lot of money in your account, but they want to make sure you're going to use that money to pay them back. They want paid back, and they want proof that you have the character to pay them back. So I recommend getting a credit card and paying it off in 30 days. And then
It's
of
the
course,
quickest way to improve your credit score.
exactly.
No question about it.
You do need that payment history, absolutely, to get any advance money.
And they will look in a small business at your personal credit score, not just your business credit score.
And if that's all you have is your personal experience, your personal credit, then, at that point when you're starting out, that is what they're going to rely on.
Right. And they'll look at the history of your credit. How did you manage liabilities that you had? And not everybody has perfect credit in their history. That's for sure. And we see small businesses like that all the time. But so long as you demonstrate that you are working through whatever problems you had, and that you have cleared up any issues that you had in the past, you will be able to deal with a bank and get financing.
Jim,
But your
here's one
credit
more
score is
question.
very important.
There's one more question here, and I'm not sure what it means, but what is credit card authorization for accounts receivable?
Okay. If you have a client, you can say that I want you to give me your credit card information, and I will keep it on file. And then when I send you an invoice and you approve it, I will just hit the credit card. So
You have to
that's
have a
what that
good-
means.
You have to have a very good, secure system.
You absolutely do, because you're then responsible for any misuse of that credit card if the data gets stolen. So unless you have a strong system in place, my recommendation is that you just get a credit card payment at the time of each invoice. So I have a number of service providers now who have established an ability to send me an invoice by email, and I can click on the email, enter my credit card information, and make the payment. That
A
is
lot of
certainly
times
something worth
the
exploring.
software companies have the security. If you run your credit card payments through your software company, they will have that security in place already.
But
like
if
a
they
quick-
if
like
you
a
don't and they
QuickBooks.
don't, then be very careful.
I'm sorry?
I said, if you don't and they don't,
Yes.
then be very careful about collecting and keeping that kind of information. Okay, banks will also obviously look at the ability of the business to repay and the equity in the business. And some final tips here. First off, we recommend strongly that you establish a banking relationship right out of the blocks, even if you're not trying to get a loan. Why? It's a lot harder to walk in and on a cold basis, introduce yourself and say, hey, I'd like to get a loan. You're going to open up a bank account for your business, a commercial account. Meet with that bank. And as I said, the best is to deal with a community or a local bank. And meet with an account manager and explain what you're doing. Explain what your business is. Start to establish a relationship with them so that they understand your business. They get more comfortable with you. And as and when you may ultimately need funding, you may have a more ready reception to that possibility. You should establish merchant credit for supplies so that you don't have to pay cash every time you're getting deliveries. You can consider
And
working capital financing and keep working on establishing a good track record in your business for any future needs you might have.
Jim, there's a question here, and I think you may have already answered it. How important is optimal capital structure for a small business?
Well, there is no optimal capital structure, but any outside lender is going to look at how much equity you have in the business. What is the investment that you have made? What is the excess of the value of your assets over your liabilities? So the more that you can show a capital cushion in your business, the better success you're going to have. And you should always strive to keep a cash reserve on hand, especially now that you can get a 5% payment, 5% interest payment on cash balances in CDs and otherwise. You should make sure that you keep 6 months cash reserve in your business if possible, because that's going to give you the most ultimate comfort that you are going to live to keep fighting another day. Okay, so we have any other questions?
No more questions in the queue.
Teresa, do you want to invite the bank back?
Oh, sure. Oh, yes. Yeah, did Seth and Robert, did you have any other closing comments on the importance of cash flow and why that's important to the bank?
Batter up, Robert.
Me, I know I'd mentioned this, it may have been the last call or maybe an earlier call on one of these webinars, but always, so when I've discussed, when I've sat and met with business customers just starting out, what most, I would say a good 80%, they're not properly planning. And what I mean by that, they have a good idea, but they don't have, basically, they haven't done anything to prepare to have the cash to implement their idea. So that's I think the biggest takeaway that I've seen. And the second, and I think I've talked to you, Jim, about this. You can sacrifice profits for cash flow. Cash flow is king, which you discussed earlier. So don't focus on profits initially, but having the cash flow, because the first 1 to 2 years of business, it's gonna it's gonna be challenging. It's gonna be difficult. So at least once you get to the second, probably a third year, fourth year, that's when you can see if your business will survive. So again, in my experience, it's really about the cash flow.
I would definitely support that, Robert, and just suggest that in this presentation, Jim goes through the 5 C's of credit, and that I can't overstate how important it is to review those, look at those, and understand those, because they're all super important. And the one that was capital, where we talked about making sure that you've got extra cash in case something happens. You know what? Something always happens. Nothing ever goes exactly according to plan. And in my experience, the businesses that get in a little bit of trouble are the ones that have a little bit aggressive ideas about when their customers are going to come in and start paying for stuff. So it can take a little bit longer to finish building out that space, a little bit longer for that advertising or those clicks to get your customers to come in. And every month that goes by, you've got expenses regardless of whether you sell a thing. And so planning is super important. And I'll just say, I've had many people ask me if I can help go through a business plan with them. And I point to my friends at SCORE, and I say, listen, SCORE is the SCO of retired executives. And the retired executives is the part that I like to think about, because these folks have run businesses. They've done this They have the experience of the ups and downs, and are wonderful at challenging you and your assumptions and saying, how do you know that this is what's going to happen? Why are you getting so much inventory to start? Why is your marketing budget this much here? And those questions make you really think about if you're set up for that success. Robert and I talk to so many customers that have awesome ideas, but it takes good planning to make those come to fruition. And your friends at SCORE are going to be the best people you ever talk to. I personally guarantee it.
Thank you.
I couldn't underscore enough what was just said, which is you'll put your plan together. You'll talk to whatever advisors you want to talk to, but I can almost guarantee you that things will not work out exactly as you put down on that piece of paper. It'll always take you longer to get to where you think you're going to be on a break-even basis. So you just have to be realistic about where you're going to get and how long it's going to take you to get there. Because, this is a major step for you in running a business, and you want to make sure that you give yourself the absolute best chance to succeed. But be realistic about how long that's going to take.
And that's true with companies that vertically integrate. You might be selling candles and you're like, you know what? I really want to sell incense. Okay. So how do you know the market for incense is as much as the market for candles? Are you an insurance company who's going to buy another small insurance company because the profits on that are pretty static and it's a numbers game? The more customers you have, the more you're going to make. Are you overpaying for that? Is it the right market for you? Can you manage that other office in the same way you manage yours? And I love talking to companies, Jim, who have a business and they either want to grow it by leveraging up some bank debt to buy some additional assets or salespeople or whatever else. And I say, okay, you've got this other business, it supports X, but you need Y. Let's just make sure that you've done the homework so you're going to be able to, that extra salesperson you hire is really going to double your business. Who are they? What's their resume like? Or, how do you know incense sells the same as candles? Or can you sell insurance in Roxbury in the same way that you sell it in Arlington? And, so all this stuff that Jim's talking about applies to growth companies as well as startups. If you got a company that's humming along, talk to your banker about what are your 6, 12, and 18-month plans. What do you dream of, and are you thinking about it the right way? And SCORE will come in not just for startups, but for these businesses that are looking to grow as well. It doesn't cost a nickel to talk to me or Robert or Jim, so make the time is what I would say.
It's something that people often miss, which is that every time you think about growth, it comes with expenses. And that doesn't mean you shouldn't be pursuing growth, but you need to be realistic, again, about what those expenses are going to be in order to get the growth that you're hoping to get. And make sure that you've built that into your cash flow forecast realistically.
And I know Gloria is typing in an answer to this question, but I'm going to say it out loud because I think it is really, really important. This person's saying, I'm not a startup, been in business for 11 years, still have cash flow problems. Can you recommend a mentor? I guarantee you that every single chapter of SCORE has got a cash flow mentor or a mentor that can help you get your cash flow figured out or organized, help or explain to you how that can be done. So absolutely, score.org, put in your zip code, get matched to a chapter, and they will suggest a mentor to work with you. So
and it's better to do that with your local chapter because they understand the local market.
Exactly. So score.org, put in your zip code and tell what you need, and they'll match somebody to help you out. Okay. Well, I think that covers everything. I think we've covered all the questions. I want to thank everyone for joining us today. I want to thank East Cambridge Savings Bank for being a sponsor, and definitely thank Gloria and Jim for giving their time to teach us about cash flow today. Thank you, everyone.
Thank you.
Thank you.
Thanks.
I'm just giving Gloria a chance to finish typing her
No,
answer.
thanks.
Because I see you were typing, so I won't close out. So Kristen, Gloria's answering your question right now.
Bye, folks.
All right, thanks. Thanks, Gloria.
Okay.